Good afternoon. Welcome back to Money Control's live stream. You're watching Closing Bell with me, Lovisha, Darad, and my colleague Nandita Khemka. Well, Nandita, quite a bit of a turnaround for markets in the last hour of trading session. We saw Sensex shave off that 850 points from day's high. Even Nifty was down about that 250 points from day's highs. Sensex closed at 77,578 odd levels, so up about 200 points, while Nifty ended up flat in the green above that 23,500. So from 23,750, we are back to 23,500. So the nervousness has emerged after Ukraine hit Russia with the Western-made missiles for the first time. So now a deeper escalation could be anticipated since Moscow has vowed a nuclear response in return as well. So Nandita, what do you make of the markets at this point of time? Because quite a bit of turnaround in just the last hour of the trading session we saw.
That's true, Lovisha. Not the last 1 hour, I must say. Last 20 to 25 minutes, has completely changed the texture of the market, right? And it's clearly the geopolitical jitters that has hit not just the Wall Street, but even across world market, right? The US futures, Dow futures were down somewhere around 0.6% last time I checked. European markets have also shed quite a lot of weight, like 1% loss coming in on the likes of CAC, DAX, and FTSE as well. So, this latest strike, according to Bloomberg, that's as per report. That has, clearly led to jitters because, this change in policy by Biden administration had invited warnings from Russia as well. Now, we'll have to see how this escalation really pans out because, Russia, of course, as you mentioned, clearly had warned of, nuclear retaliation if something like this happens. So, Ukraine was given permission by the Biden administration to use their long-range missile to strike deep into Russia. And according to reports, the first strike has emerged. So let's see how this, geopolitical scenario really pans out. But for now, not looking good, given the fact that we did heave a sigh of relief today after 7 straight days of incessant selling. Some bit of green. At one point in time, the Sensex was up 1,000 points. The Nifty was also above that 23,700 mark. So, a lot of ground has been lost in the last 20 minutes. And that is a cause of alarm because, we had some good data points to work with. Dollar index had also cooled off slightly. And we were hoping for, perhaps looking at FI buy figure today because, FI sell-off has also kind of tempered down if you look at the FI sell figures of the last 2 sessions. So yes, the entire texture of the market has changed. Even the broader end of the markets gave up some of their gains, although the breadth was in favor of gainers towards till the end of the session, almost 2:1 NSE advanced decline ratio. But clearly, much more reaction will be seen when we open for trade on Thursday morning, tomorrow being a holiday, Lovisha.
That's right. A lot of That's right. A lot of sectors that also enjoyed in the positive territory in the initial session and throughout the session. But of course, the last 20 minutes, we saw energy, infra, metal and the PSU bank indices, all of them came under pressure. We saw India Wix, the volatility gauge also jumped over 3% to settle above that 15 mark. But moving on to some of the top Nifty 50 gainers and losers. The top Nifty gainers has been the likes of M&M, Tech Mahindra, HDFC Bank, Trent and Eicher Motors. M&M, of course, after CLSA gave out its outperform call and gave out a target price which implies a 16% potential upside. Apart from that, IT stocks did well in today's trading session after yesterday's lag. We saw Tech Mahindra also in the top Nifty 50 gainers list as well. But if you look at some of the top losers on the Nifty 50, we can see the likes of SBI Life, Hindalco, Reliance, HDFC Life and Tata Consumer Products. So some of the insurance names have popped up in the Nifty 50 losers list after Center aims to increase the FDI allocation in the sector. So yes, quite a bit of up move in the market, but yes, just quite a twist and turn in just the last 20 minutes. But on the broader end of the markets, mid cap and small cap indices that did well, and it is up ended with about 0.9%, nearly a percent gains. So what do you make of the broader end of the markets, Nandita?
Lovisha, quite a few movers in the broader end of the market, some based on news flow and some, on the back of volumes. V-Guard, that was the top mover on the Nifty 500 index. Strong revenue growth in the quarter gone by, double-digit 15% kind of a revenue growth on a YY basis. Despite challenges like weak consumer sentiment and extended monsoon, the firm did manage to show strong revenue growth. But aside of that, some of the other movers included the likes of Apar Industries, Jyoti CNC, Craftsman Auto, EID Parry as well. But on the flip side, look at Honasa. That stock has shaved off in excess of 30% in the last two sessions. Of course, there has been a shift in strategy. Numbers weren't all that great. It reported an EBITDA loss, invited downgrades from brokerages as well. Of course, as I mentioned, the stock has shaved off 30% in a matter of two sessions. Aside of that, MapMyIndia continues to reel under pressure. It reported earnings last week weren't all that great. Selling continues there. And as you mentioned, insurance companies were under pressure, right? HDFC Life, SBI Life, Max Financial, all these companies were under pressure given the fact that at an event, Finance Minister had, raised concerns about mis-selling of insurance products by banks. And now a lot of these companies get their, a big percentage of their annualized premium equivalent from bank assurance. Say SBI Life, HDFC Life, all of these companies get 60 to 65% of their APE, or what's APE, that's what you call it in insurance terms, from bank assurance. So that kind of concern that was raised by FM kind of spooked these stocks, and which is why they were reacting in trade today. Adani Green and Thermax were some of the losers on the Nifty 500 index. But Lovisha, on that note, let's get straight to the stocks that are on our radar this afternoon. Which is the first stock that you've taken?
Well, the first stock is M&M, Nandita, because it was one of the top Nifty 50 gainers as well, and it surged about 4% in today's trading session. Well, the upmove came after CLSA shared an outperform rating on the counter and shared a target price of 3,440 rupees per share. Now, this implies an upside potential of 16% from current levels. Insights from CLSA's engagement with M&M's management revealed that there is a strong confidence in the automaker's growth trajectory, especially with their extensive launch pipeline. Now, the analysts believe that the new launches would drive growth in the fiscal year 2025 to 2026. Analysts also noticed that over the past 5 years, M&M has increased its SUV mix to 55% from 35%. Now, there was a shift in consumers' preference pattern too. Analysts said that the buyers are increasingly willing to pay a 10% premium for enhanced features, transitioning from traditional mileage-focused priorities. So, apart from that, electric SUVs, that is also anticipated to see significant growth in the domestic market over the years to come. So, apart from CLSA, Jefferies also had highlighted M&M's strong tractor segment, improving automotive franchise and attractive valuations. So, quite a bit of a good commentary coming in for M&M stock. But if you look at the charts after October highs, the stock has also started to build a positive momentum again. So, we'll see whether or not this up move sustains in the upcoming sessions as well, Nandita.
That's true, a high flyer, and in top gear in today's trade was M&M. That was the top Nifty gainer. Throughout the session, it was maintaining gains of somewhere around 5% or thereabouts. But the first stock on my list, Lovisha, is a high flyer today, Suzlon. That stock hadn't really been doing well off late, but an upgrade from Morgan Stanley clearly got the stock fired up in trade today. That was up 5%, hit upper circuit today in trade. Target price, although, has been cut by Morgan Stanley to 71 rupees from 78 rupees per share. It has an overweight rating on the stock from equal weight earlier, and it believes that the steep correction that the stock has seen, mind you, it has corrected from levels of 86 to somewhere around 56 or thereabouts. So that has been a sharp 30% correction in the stock in the last 3 months. So the stock after this correction presents an opportunity to accumulate. That's according to Morgan Stanley. Now the stock, the company has a very good or strong order backlog of 5.1 gigawatts, and that's executable over the next 24 months. And the company is also being prudent in taking up future orders with higher focus and on higher offtake visibility rather. So these orders bode well, and the company in fact will be a beneficiary of India's transition to green energy as well. Now Morgan Stanley is expecting the company's market share to go up to 35 to 40% by FY27 vis-a-vis its current market share of 25% in FY24. So that's a good market share gain that's being predicted by Morgan Stanley. In terms of sales volume for FY25, the sales volume has been lowered to 1.3 gigawatts vis-a-vis 1.5 gigawatts earlier. But for FY25 to FY27, the sales volume has been kept unchanged at 7.15 gigawatts by Morgan Stanley. Now, some of the other strong factors that have been highlighted by Morgan Stanley are the likes of the strong business mode that the company has and the growth opportunity for wind OEMs in general. And that, makes the company well positioned for growth going forward. As I was mentioning, the stock has corrected quite a bit from 52-week highs of 86 rupees or thereabouts, down over 20% in the last 3 months. But I want to point out the kind of meteoric rise the stock has seen from March 2023 to September 2024. The stock, of course, has given multi-bagger returns of 9x. But of course, it struggled to maintain that momentum, and in the month following September 2024, the stock came under a fair bit of correction. Although brokerage like Morgan Stanley is upbeat on the stock. Some brokerages are wary given the kind of rise that the stock price has seen. They believe that the business is strong, but the pricing really doesn't really justify the good business that the company has. So yes, the views are really, kind of divided, but Morgan Stanley right now is fairly bullish, and who knows, after today's move the stock can actually march back to levels of 80, 85, 86 or so.
Yeah, that's right. 71 target price by Morgan Stanley, 14% upside that they are watching out. But we'll see whether or not these moves are seen in the upcoming sessions. But the second, the third stock in focus was the aviation ones. We saw the likes of Indigo and SpiceJet surging as much as 3% in intraday trading session. But SpiceJet lost the momentum and settled in the red in today's trading session. Now the up move came after the Ministry of Civil Aviation noted commendable air traffic in a single day. The ministry said that on November 17, air traffic crossed about 5 lakh passengers for the first time amid the buzz of festival and wedding seasons. Even the festival departures, that rose over 3,100. Now, the optimism in Indigo stock also came after Goldman Sachs maintained its buy rating on the stock and shared a target price of 4,800 rupees per share. Now, the brokerage call came as Indigo's October as well as November air traffic stood healthy, while payload factor saw a notable increase to 90% from 85.6% last year. Now today the stock has seen some breakout. Otherwise, if you look at since October, the stock has been on a downward spiral after it slipped back in red in the second quarter. So we will watch out whether this up move is sustainable going ahead and what it means for the aviation stocks as well. What is on your radar, Nandita?
Well, of course, that was about aviation stocks, but one pocket that has been making headlines and for all the wrong reasons is the city gas stocks, right? The space was once seen as a game changer due to its cost advantage over traditional fuels, but it is now faced with tough times going forward. The government has sharply reduced the supply of cheaper domestically produced natural gas to these companies. After cutting domestic gas supplies by over 20% in October, they have slashed another 20% now. Now, this has brought gas allocations down from 154% in FY21 to just 30 to 35% today. Now, what's more worrying is that global brokerage Jefferies has said in its recent report that by mid-2025, domestic gas allocations could come down to nil. And without this cheaper gas, companies supplying CNG for vehicles and piped gas for cooking will have to rely on expensive imported gas, which costs about twice as much. Now, they'll need to source a mix of spot LNG, high pressure and high temperature gas from new fields and APM gas as well, and that will significantly drive up their costs, right? They will in fact need to buy about half of their gas supply at market linked prices, and this will squeeze their profit margins and hit their earnings hard. Now, analysts say that city gas distributors may have to hike CNG prices by up to 10% to protect their margins, but that would reduce CNG's price advantage over petrol and diesel. An ideal scenario would have been gradual price hikes like in the case of petrol and diesel. But with the rapid cut in gas allocation, CGDs may not be able to pass on hikes gradually. And do these companies really have the capacity to stomach such a rapid reduction in gas allocation without taking a significant hit on margins? Probably not, given the fact that price hikes may have to be much larger to remain margin neutral or ensure minimal hit to margins. Gone are the days of 20+% return ratios, but expectations may have to be petered down to 14 to 16% when it comes to return ratios. MK Global, for instance, is now assuming a 14% ROE model for both IGL and MGL for FY26, FY27 vis-a-vis 17 to 18% earlier. ICICI Securities has pointed out that the cost gap between CNG and petrol diesel, which is currently at 35 to 48%, leaves some room for price increases without completely eroding CNG's appeal. But higher prices may still, slow growth as new customers may think twice about switching to CNG. Now, the market has already reacted strongly, right? Shares of IGL, MGL have dropped over 40% since October, when the first cut in allocation took place. In fact, now some of these stocks are at levels last seen in 2017. So the question is there more downside? I was just talking to Mayuresh Joshi of William O'Neill today. We were discussing this topic. He said that he believes most of the bad news may already be priced in. He expects these stocks to stabilize, but doesn't really foresee any major positive triggers for now. And there are, of course, short-term challenges with respect to gas availability as well. Now, despite the challenges, the long-term potential for these businesses isn't entirely lost, according to some experts. In fact, they say that they could expand into intercity pipelines, regional networks, and LNG refueling stations, in fact, as well as focus on urban growth and better last-mile connectivity. Now, these steps could open up new markets and reduce reliance on specific segments like two-wheelers and three-wheelers as well. Now, some experts I spoke to also said that companies may have to tap inorganic opportunities to improve their prospects. But will these measures be enough? Only time will tell. But for now, I think the road ahead looks really bumpy for some of these city gas companies, Lovisha.
Yeah, that's right. Margins could be under pressure and could be under check, but we will see whether once the quantum of the price hikes are also announced. But yes, apart from the secondary markets, if you look at the primary markets, we had the much awaited NTPC Green Energy opening up its subscription numbers. It has been subscribed 30% so far on the first day, and retail book has been fully booked. So yes, NTPC Green, that is for you. But with that, we have come to an end of this edition of The Closing Bell. Thank you for watching. We have a market holiday tomorrow on account of Maharashtra election, so we will be back with markets on Thursday. Signing off, Nandita and me, but do stay tuned to moneycontrol.com for more news updates and market insights.